Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go to Twitter. We're going to look and see what people are talking about. I found some stuff today pretty amusing to read. I just thought it was funny because you've got one person making like a serious comment and then someone makes an unserious comment. I just think it's kind of funny. So we'll read through those. I'll give you my financial opinions on what I'm seeing in the markets here. Maybe I can add some stuff at the end of kind of what I'm seeing in the markets and what my opinions are there too. So we'll start with Twitter here. And again, if you want to follow me, you can follow me at finding_finance on Twitter. So I thought this was kind of funny. Dr. Paul Dorfman, he says, wind and solar with battery backup cheaper to build than gas in Ontario and Alberta. And the price of the renewable options is expected to fall another 40% by 2035. And this guy says cheap to build, lucrative for developers, but somehow massively drives up rates. Wind and solar are cheap way to make expensive electricity. I just think that's funny. It doesn't even make sense because wind and solar are cheap way to make expensive energy. Well, if it's expensive, it's not a cheap way to do it. And I know he's making fun of this guy here, but I just thought that was highly funny because wherever they put in more wind and solar, it seems like to me, because of the unreliability of those electricity producers and how it matches up with demand in terms of time of day and when they actually generate electricity from wind and solar, it ends up being very expensive. So wherever we put it in and implemented it, it just doesn't seem like it's a great way to generate electricity. So I just thought that was incredibly funny. Here's another one. It says, the risk factor with energy investments continues to drop. The combined loan book by Canada's 6 big banks shows a 92% decrease in impaired loans to oil and gas to 230 million. What are the additional implications? And there's a thread on this. So we've got impaired loans to oil and gas split by the big 6 Canadian banks. And you can see that this has drastically declined. Basically, they're earning and cash flowing a lot of money in relationship to their debt. And they're basically coming out of that debt cycle, having a large risk back in 2020. So the thing here says the bank's comfort in the oil and gas sector plays a major role in capital spending plans and ability for mergers and acquisitions. Despite loan impairments down, the banks have still reduced their overall lending to oil and gas by 54% since quarter 20 to 27 billion. So you can see the loaning has gone down, but you also have to keep in mind that the companies are also cash flowing a lot of money where they can use that money to either pay down debt or to fund a lot of the expenses. It says, on a relative basis, oil and gas is now only 1.8% of the Canadian bank wholesale loan business. As ancillary fees decline, so too as desire to lend, especially to smaller cap E&Ps. The result is less sector growth, less farm teams for the majors, less exploration, etc. So this is the oil gas percent of all business loans. It is definitely declining all the way down to 1.8%. It says, will lending pick up? Maybe. Oil and gas loan impairments is now 0.8%, which compares to all businesses loans at 0.5. Overall, the risk the big 6 banks have with oil and gas is clearly subsided. In any event, this should give comfort to equity investors coming back to the sector. So there's the loans impaired, and we are converging back to all businesses. It was a very risky spot at the bottom of 2020 since the price of oil was definitely below the cost to produce oil. So that is a thread on oil and gas, just to get you guys up to speed. So the risk is declining rapidly, but with declining risk, generally declining returns also happen as things become a lot more robust. Here's oil and natural gas ratio. This is Jay Hinster, blow off top, natural gas is bottomed. Now, I don't know if this is bottom, but it is at a very cheap ratio. I show this also on my charts as well over a long time frame. The inherent energy equivalent of natural gas to oil and the way that we're measuring this is a 1:6 ratio. Generally speaking, the average is higher because of the ease to move oil around. It carries a large premium in relationship to natural gas. But natural gas is very cheap at a ratio of about, I'd say, 24 and up. So you get above 24, that's when natural gas gets really cheap from a ratio perspective, and we're even past 30.8. If I were to look at it, and you guys want to get a real-time crude oil to natural gas ratio, I think it's at 36. So this is crude oil divided by natural gas. And what this ratio is telling us is that it is dirt cheap. We are at 31.63 is the ratio right now. 31.63. So yeah, it's 31.63, super cheap in relationship to crude oil. And I will say, when this thing starts to turn and bottom around, that is when I'm going to go into natural gas. At the companies, at least. I don't play natural gas directly. I only play the companies. It says, when I look back, my great stocks took a long time to work out. It was the third, fourth, fifth year I owned them that they did so well. It wasn't the third month. It wasn't the ninth month. That's Peter Lynch. Peter Lynch is a famous investor, was one of the highest returning mutual funds, and he was a fund manager. And that's his opinion. So what we need to be doing is we need to be looking at the time frames that are longer than a few months, and you have to look out for the years time frame. It does take a certain, maybe a certain personality, maybe it's a certain mindset, however you want to say it, to get into that time frame. I'm in that time frame. I look at things from that kind of longer term perspective. I cost average in when things are cheap, and then I hold on. That is not a trading mentality. A trading mindset is you don't want to own anything and you only want to be in for a short period of time. I am not that mindset. I don't like holding cash. I like buying and investing and holding on. That's just my mindset. And when things look cheap, I'm going to go in and buy it. That's just the way I view it. Michael Guyette, I think this is incredibly funny. He said, breaking, stocks crashed to levels not seen since 6 days ago as bears scream victory. I just think that's funny as heck. Since 6 days ago. Yeah, that's just immature retail investors who can't handle volatility at all. So here's another one. It says World Central Banks. It says 2022 was not only the 13th consecutive year of net purchases, but also the highest level of annual demand on record back to 1950 in terms of gold demand. So this is World Central Bank gold demand trends, and you can see a massive move into gold. Perhaps this is we'll say the unwillingness to buy bonds of other people's because of the currency risk and the bond default risk is increasing. So as countries start to distrust other countries, you're probably going to see gold purchases spike like it did. And maybe we've got problems in bond markets because countries are so unwilling to buy bonds, perhaps, and they're choosing alternative investments like gold. Here's coal. So coal has dropped almost 50%, with most of that occurring in the last month. This guy's saying disinflation. The way that I see this is a big basing pattern. You can kind of draw a line through here. And it broke through the base. It did a little retest. It shot on up. And I think this is actually wave one of a much larger move that's coming ahead of us. I think that we do have energy problems and that the energy problems have not been solved. So that's my take on coal. I think it's also following natural gas, and natural gas is getting a big pullback. I view it as a great opportunity to be patient, and eventually, hopefully, the companies fall down some and we can get some really good prices on the companies, not just coal, but natural gas as well. This is the mortgage rate clouds, kind of an interesting looking chart here. It says, after a decade of descent, the valley of 4 or 5 in 2022 opens up with a steep climb to 6 in 2023. So you can see that we had rates back in 2001 that were more towards 7, and you can see the cloud kind of shifted its way down lower, and it bottomed in 2021, 2020, that time frame. Then you can see 2022 was a very volatile year, really moving everywhere. It went from all the way to the peak here, all the way kind of to the bottom here. And it was a very wide interest rate in 2022. And then 2023, you can see that we've been clouding around the just above 6 interest rate. So I think that's all very interesting to kind of see this. I've never even seen the cloud like this, but it's kind of cool. Wanted to share that. Here, I like Ronnie. I think this is funny too. Biden, there will be no recession in the U.S. this year or next. PBS interview. I just think that's funny. Like this guy, I mean, maybe that is the case. That might be the case. I don't know. But I just think it's funny that he's coming out there with such confidence and just throwing it out there and chucking it out there. Here's China and India. It says, will easily displace lost exports to Europe. So what this is Russian crude exports to Europe versus China versus India. The crude exports have definitely declined for Europe, but you can see that the exports to China, India, and the combination in the yellow are a dramatic increase in those, we'll call it imports to those countries or exports to those countries. So yeah, it looks like China and India are definitely taking all the exports versus Europe. This is from Silver Chartist Steve. He says the roadmap is proceeding exactly as expected. Ratios are a powerful tool. And what he's got here is a uranium to gold ratio. The ratio is breaking to the upside here. This is the large resistance line for that ratio. And it is breaking to the upside for uranium to outperform gold. So I think uranium is in a very good opportunity here, in a very good place to actually outperform gold itself. So that is uranium. We've got Uselink also, Casper. He says URA versus the SPY. This is the S&P 500. It says after 10 long years of massive underperformance by uranium miners versus the S&P 500, we've got a massive move to the downside here. 97% decline of these two assets priced against each other, URA versus SPY. We've got a big old pattern developing where we could break out of this to the upside and have a big old fun run. Now, even if this breaks to the downside, I think it'll be a false breakout given the market conditions, the deficits of uranium, and all that. So I would see it as a buying opportunity if this breaks either up or down or even right where it's at. That's my take on it. Rolling on down, this is UEC versus uranium futures pricing. It says, now that's a squeeze, which you don't see that often. The amount of pressure here is immense. Either way we go. The momentum is top to the upside, therefore also a higher probability. So we entered from the downside up. We are squeezing all the way up to the corner in this ratio of UEC divided by uranium commodity futures, and this thing could break at any time. So uranium on a long-term perspective looks absolutely beautiful. And I know you guys on the short term, a lot of retail investors get scared on price volatility in the short term, but know this looks absolutely excellent from a long-term perspective for all these different charts. This is another long-term perspective from Grady too. It says, to get out of the rat race takes strategy, stamina, knowledge, discipline, and sacrifices. Commodities bull is best opportunity you will ever have. Extremely undervalued even after a 220% baby bull move. This is a true generational opportunity. This is commodities versus the Dow. And you can see that double I call it the booty bottom. You see the double bottom, and then we're going to eventually work our way on higher, where commodities could vastly outperform the Dow Jones Industrial Average. This is going to take time. This is not a month type of thing. And he even says the chart has that preparing slingshot look where you kind of pull it back and then it flings on higher and really starts to move. This could happen very quick. It might not happen very quick. All we know is that this pattern is lining up for a big move to the upside, the ratio here, for a vast outperformance of commodities. Here's Happy Hawaiian. It says in June 2022, 6-month CPI was 13%. By December, it had fallen all the way to 0.3%. So we are seeing some disinflation. It says, I do think the Fed has hiked too far and too fast. The economy can't handle this. And that's his opinion there. So I'm trying to get a well-rounded opinion and show you guys that the consumer price index is falling and that interest rates could be a little bit too high. We'll find out where they go. We'll see. And maybe that will slow down inflation and slow down the housing market and slow down some of these things. That is a possibility. And we're going to have to ride through it to where, if things slow down, I think interest rates will pull back. And when interest rates pull back, I think the inflation will kick back on. That's my opinion. We've got Crazy. It says, earning earnings yield for U.S. stocks is now close to turning negative versus the Fed funds rate for the first time since the tech bust. So this is U.S. stocks earning yields versus the Fed funds rate. We've got a massive move higher. I mean, look how fast that thing's gone. Usually they're a little bit slower than that. We had a pretty big move here too at smaller increments. And then you can see the earnings yield peaked and started to head lower in that decline here. But we've moved on up. We're starting to come back down. I do think at some point we'll head back higher out in the future. But that is something to watch, and that could be a little bit of a recessionary type movement there. So I wanted to share that as well. And that's where I'm going to end it. So that's what we've got for today on the markets. A lot of good information there. I think uranium still looks really good. I like the Baltic Dry Index. I like uranium. I like natural gas. I like oil. Those all look really good right now from my perspective. Energy service companies too. Those are the sectors I like the most. And that's where all the opportunities I think are kind of lining up. And I talk about it a lot on the website. The Platinum members, I kind of talk to it about them. If you take a long-term investment approach where you're not looking at it by months, you're looking at it by years, like you basically talked about Peter Lynch in this video clip here, I think there's going to be some really big returns. But if you're trying to time things in the short term and the volatility, I think you're going to get kicked out because you have to get used to that volatility. You got to ride through it. If you take a longer-term approach, I think it's going to be really rewarding to be holding on to some of these companies that are just dirt cheap right now. They're dirt cheap. But that's what I've got for today, guys. If you like the content, give me a thumbs up, subscribe to the channel, and we'll catch you next time. This is Finding Value.